we can just spend a minute talking about gold price fundamentals first before I get into the presentation on Gold Royalty Corp. Do we still have the slide here on gold performance over a 50-year horizon, or is this the most recent presentation?
This is a more firm specific.
Okay, well, I can talk to it verbally, and I think before I get into the highlights of our story, what I wanted to talk a little bit about how gold has performed over a 50-year horizon, really since gold abandoned, or the U.S. government abandoned the gold standard back in the early 1970s. And really, gold has been a one-way trade over that 50-year horizon, going from $35 an ounce to over $2,800 an ounce most recently, as it achieved an all-time nominal high. And over that period of time, we've also seen the purchasing power of the U.S. dollar, and for that matter, most fiat currencies decline by upwards of about 96, 97%. So the temptation for U.S. government and for, frankly, central banks globally in the Western world is to continue to expand money supply in the absence of having the tether to the gold standard as we experienced in the earlier part of the 20th century. And so gold is the one currency you can't print. It can't be manipulated. It isn't the obligation of any government. And why it's performed so well in its most recent 4 or 5 years is because we've seen a massive expansion of money supply, really going back to the great financial crisis. It's unprecedented. And what I think is likely to happen is a continued expansion of money supply, notwithstanding the fact that we actually started to see nominal rates pivot over the last several months. We are starting to see more pronounced inflation, likely to be more deeply entrenched, and certainly in the interests of central banks and governments globally to see inflation actually, increase in momentum, because we've never seen debt levels today as we've seen in the past. Today, we're seeing global debt to GDP of about 350%. In the last large inflation cycle we saw in the 1970s, global debt to GDP was only 100%. So there's very limited scope for central banks to expand money supply or to expand debt levels and increase interest rates significantly. And so we're likely to see inflation accelerate. And gold is really an accurate, agnostic barometer of what's really happening in inflation. And I think nobody on this phone is experiencing 2 to 3% inflation. We're all experiencing double digit in our everyday lives if we're buying shelter, food, or fuel. And so those are really the big consumers of our pocketbooks. And it's in the interest of central banks to see inflation entrench in order to inflate debt away, because there's no fiscally responsible way to deal with the massive amounts of government debt that's been piled on, and for that matter, at the corporate and individual level as well. So in that light, if you buy into the investment thesis for gold, I think the question you have to ask yourself as an investor, where are you best placed to get optimum leverage to the gold price? And unfortunately, in the producer universe, in the gold equities, they're experiencing significant inflation in their input costs, whether it's capital operating costs. And we've seen evidence of that in the most recent quarterly results for some of the biggest producers in the world, namely Barrick and Newmont. And we've seen a significant underperformance of their equities relative to the commodity because of the concern of the overhang of inflation. And what exasperates the underperformance is the fact that the global producer universe is shrinking as reserves have been declining for over a dozen years due to the lack of exploration and reinvestment back in the ground to replace depleting reserves. So we're seeing the combined forces of declining reserves and increased operating costs undermine the leverage propositions that producers should be providing you. And I think where you're best placed to get optimum leverage to the gold price is, frankly, in the royalty universe, which is what the gold royalty model offers you. It's top-line exposure. We have over 240 royalties in the portfolio, and those 240 royalties are almost exclusively on gross revenue. So that means that we are exposed to the revenue at the mine site with complete insulation from operating and capital cost inflation. So it's top-line exposure. So that means that our margins are unmitigated by inflation at the mine site level. And so you get full exposure to the gold price within a vehicle like Gold Royalty Corp. And not only that, we offer significant diversification, which no operating company can hope to achieve, with over 240 royalties. And you're looking at nearly half of the company here, and Jackie, myself, and Peter. We have a scalable model, and we could run a portfolio of 10 times the size with the same number of people. So that means every incremental dollar of revenue growth goes right to the bottom line. And this year is an auspicious year for Gold Royalty Corp because we're at a free cash flow inflection point. Having only IPO 3.5 years ago, we've gone from a startup with no revenue to actually almost tripling our revenue this year and the first full year of positive operating cash flow and significant cash flow growth right through the end of the decade, organic growth from a royalty of over 240 royalties that are completely bought and paid for. We have 60% compounded annual growth in our revenue right through the end of the decade. And as I said, that incremental revenue falls right to the bottom line and puts us in an excellent position to start returning capital to shareholders in various forms. And while we have significant optionality in that portfolio, we also have some of the largest scale mines within North America that we have royalties on. In fact, 3 of the 5 biggest producing gold mines are in North America within our royalty portfolio, namely Canadian Malartic in northwestern Quebec, operated by Agnico Eagle, the 3rd biggest operator in the world. We have a royalty on Côté, which will be Canada's 2nd biggest producing gold mine as it achieves commercial production in the 4th quarter of this year. And we have a royalty on the underground extension of Goldstrike, which is North America's biggest producing gold mine, operated by 2 of the 3 biggest gold producers in the world, Barrick and Newmont. So it's not only a diversification strategy, we have a quality proposition with royalties in some of the longest life, largest scale operations of the world with some of the best capitalized operators. So it's not only a quantity and diversification proposition, it's a quality proposition. And the reason we've been able to grow this royalty portfolio out so quickly and dramatically and delivered peer-leading growth in revenue is because of the quality and tenure of our board of management. Collectively, we have over 400 years of industry experience within our board of management, which gives us 2 distinct advantages. One is gives us a clear-eyed view of the underlying risk of what we're investing in. Because like myself, many of my board of management have been in operating and mine development roles. So we understand the inherent risk of what we're investing in, and we can price that risk appropriately so we can get an adequate rate of return on the capital we're allocating to the royalty opportunities we have. But not only that, we have access to virtually everybody in the industry because many of us have been operating in a large cap environment. So we have a network that's second to none in the royalty space. And that's allowed us to accumulate a royalty portfolio effectively on an exclusive basis. We haven't been in competitive processes in any of the acquisitions we made, which means we can price things without the competitive pressure that some of our peers face, so we can get an adequate rate of return on the capital we invest in new royalty opportunities. You can go to the next slide, Peter.
Hey,
thank you.
David, if I can interrupt you. I got a couple of questions that came in.
Sure.
Excuse me. So actually sort of both along the same line, so I'll go with the second one. What is the company's stock performance beta correlation to the price of gold to the price of gold? And even with your long-term positive outlook on gold prices, do you do any short-term commodity price hedging?
Yeah, well, I'll answer the second question first. We do not do any commodity price hedging. That really undermines the leverage proposition that we think investors are looking for in gold equities. We're not financial engineers, we're mining engineers. We're builders and operators, and we leave the financial engineering to the investors. If they choose to hedge their gold exposure, they can do so quite readily. It's a very liquid commodity, easy to hedge. That's not what we're paid for. We're paid to optimize the leverage to the commodity through our diversified portfolio and also through the exploration that our operating partners are undertaking. Typically, our operating partners on our royalty portfolio invest over $200 million per annum in grassroots exploration and brownfield exploration around their existing portfolio. And that allows us to not only offer optimum leverage to the gold price, but unmitigated leverage to the exploration of underlying operators. And just to be clear, as a result of this model, given that our royalties are completely bought and paid for, that exploration expenditure comes completely free to our shareholders. So I think the important thing here is offering, again, unmitigated leverage to the gold price, unmitigated leverage to the exploration success of our underlying operators while maintaining a very low cost structure and a very high margin business. In terms of leverage to the gold price or beta to the gold price, if you will, typically royalty companies have demonstrated that over time they offer far better performance to the gold price, both in ups and downs in the cycle. So I would say the beta is higher. But I have Jackie on the phone, who until recently was a senior mining analyst at BMO, and I think can offer a more learned response on her observations on that.
Thanks, Dave. So yeah, I mean, the leverage to the gold price, it really depends on which direction the gold price is going. Certainly, when gold prices are going up, royalty companies can offer more leverage to the gold price because we don't have cost inflation, which tends to go up at the same time as gold prices go up. Of course, there's going to be some times where costs are more sticky and gold prices are higher, and in those maybe brief periods, the operators or developers would probably have more leverage to gold, but kind of longer term or over most of that cycle, we're going to see more leverage to gold on the royalty streamer side because our costs are fixed or essentially zero in the case of many royalties. So I think that probably gives us an advantage in this strong gold price environment, especially as we go into the beginning of 2025, when gold companies are going to be reviewing which cutoff grades, which gold prices they use in their mine plans for the next year. We could see a bit of a step change or catch up in costs as gold companies raise their costs, mine more low grade material, and they can get away with that. They can do that because gold prices have been high, but it will again impact their leverage to gold and not ours as much.
Fantastic. Appreciate that. No more questions currently. I'll let you get back to the presentation.
Well, at this point, I'm going to hand it over to Peter to talk through some of our portfolio in a bit more detail and how we built it up, and then I'll come back to sum up. Peter, over to you.
Thanks, Dave. Taking a step back over the last 3.5 years, Gold Royalty started in March of 2021 as a public company with a maiden portfolio of 18 royalties on high quality, large scale development assets. And at that time, we had no clear line of sight to immediate revenue. Realizing we had a strong balance sheet and a strong currency, we started consolidating the sector through the balance of 2021, acquiring 3 other public royalty companies, Ely Gold, Golden Valley, and Abitibi. This brought us, importantly, cash flow into the portfolio and a strong anchor position in Quebec, Ontario, and Nevada, very strong mining jurisdictions. Since that wave of corporate consolidation, we've had to be more targeted in continuing to grow the portfolio, completing third-party single royalty acquisitions, as well as select royalty financing situations. As we sit today, we have over 240 royalties with, as David mentioned, the most robust revenue growth profile within the royalty and streaming sector. A snapshot of our portfolio highlights our 7 cash flowing royalties currently, another dozen or so at various stages of development, and that long tail of optionality, which we benefit from for free with no associated exploration or expansion costs for us as a royalty holder. From a qualitative standpoint, and as I mentioned, we have an anchored position in the best mining jurisdictions in the world, Canada and the USA, specifically Quebec, Ontario, and Nevada. I'd also highlight that our key cornerstone assets, 3 of the 5 largest gold mines in Canada and the USA, are being developed and driven forward by the largest mining companies in the sector, the likes of Newmont, Barrick, and Agnico, which not only bring the technical expertise to move those assets forward, but have the balance sheets and capitalization to continue to invest, expand, and explore those projects to extend mine lives and increase annual production rates, which benefits us as a royalty holder. All in all, and the outlook for the portfolio out towards the end of the decade, our revenue profile is really at this key inflection point. From just over $5 million in revenue, and my slide's a bit slow here, so I'll try and get back to our revenue forecast slide. But to speak to it, we had just over $5 million in revenue in 2023. Our guidance for 2024 is almost a tripling of that, with $14 million in expected revenue this year. We have achieved $9 million in total revenue, land agreement, and option proceeds through the first 3 quarters, so we're well on track to achieving that guidance, because we have a few key assets specifically Varus and Côté ramping up at the end of the year. Towards the end of the decade, as assets such as Odyssey, going to be Canada's largest underground gold mine, where we have a 3% royalty, is ramping up towards 2028, we expect to see this significant growth profile very likely be achieved. Give me one moment as I wait for my computer to catch up. Here we are. As I mentioned, a key inflection point for gold royalty from 2023 to 2024, and then that doubling again, looking out towards 2025. The chart here, the columns on the bottom show the gold equivalent ounce production profile. So how many gold equivalent ounces we are expecting to receive at Gold Royalty Corp. And this is based on analyst consensus estimates for the 6 analysts that cover us. The lines that you see are that gold equivalent ounce production profile sensitized to various commodity prices. So whether you view the gold price to be $2,000 an ounce or upwards of $3,000 an ounce out towards the end of the decade, you can see even at the lower end, we're achieving very strong firm-specific revenue growth. And importantly, a very important aspect of the royalty and streaming model is this revenue growth is against a completely fixed cost structure. We achieve approximately $7 to $8 million in fixed cash operating expenses to run our business, and we expect to maintain that as this revenue growth profile is achieved, meaning each incremental dollar of revenue growth is translating into free cash flow growth, and will give us the latitude, as David mentioned previously, to evaluate different types of capital distributions to shareholders in the future. Despite this, Gold Royalty is at an undervalued position relative to peers. And we primarily attribute this to that key inflection point I spoke to earlier. In 2023, we were not covering overheads. We were a cash burning business. And in 2024, we are now recognizing our first year of positive free cash flow and starting to bolster our balance sheet. Through 2025 and 2026, as I mentioned, we see significant free cash flow growth, a much stronger financial position, and we believe this will be a strong catalyst to re-rate our valuation back in line with peers, closer to 1x net asset value relative to the 0.5x net asset value that we currently trade at. I mentioned it briefly before, but speaking to those catalysts, what is really driving this growth in the near, medium, and long term? Q4 in 2024 and Q1 of 2025, we see 3 key assets really ramping up. The Côté gold mine is going to be Canada's 3rd largest gold mine once fully ramped up. They're on track to end the year at 90% of mill throughput, and that team is delivering quite exceptionally on the project in Ontario. We have a 0.75% NSR over the southern portion of Côté. On a similar timeline as our most recent acquisition, Varus. This is a high-grade zinc silver mine in Europe, and it's on track to end the year achieving commercial production and ramping up through 2025 as well. We hold 100% copper stream. We benefit from 100% of the copper production at Varus. And then finally, I'd highlight Borborema. We hold a 2% NSR over this development stage gold project in Brazil, which is on track for initial production in early 2025. That project is well advanced, close to 60% complete construction as of the end of Q3. Looking out over the next 2 years, we see several assets ramping up in Nevada, specifically County Line and Granite Creek, high-grade operations through Nevada, which are being developed and permitted to complete and ramp up production over the next few years, which we're excited to see could supplement our revenue profile. And then our cornerstone asset, which I've already mentioned previously, Odyssey, the largest underground gold mine in Canada, already achieving initial production, but will really ramp up towards 2028 when production from the shaft commences and the Canadian Malartic complex shifts to a fully underground operation. With 240 plus assets, I can wax poetic on several of them and what we're excited about in the long run and the optionality there. But as you can see, there are several near-term catalysts that are really driving that growth and improving the fundamentals of the company. So with that, David, perhaps I pass it back to you to talk about some of the nuts and bolts, share structure and strategic backers of the company before opening it up for more Q&A.
Yeah, great idea, Peter. Maybe you could bring up the cap table and I'll talk to that. Well, maybe on share ownership first. 20% is held by insiders. We have a significant number of strategic shareholders as well, own about 10%, and that includes Gold Mining Inc., which is the company we were spun out of back in March of 2021. They still own 12.5%. Nevada Gold Mines, which is the joint venture between Barrick and Newmont, is our second biggest shareholder at 5%. And that was by virtue of an acquisition of non-core royalties we picked up in Nevada from them a couple of years ago. Again, that speaks to the relationships and leveraging those relationships to acquire royalties on a preferential basis. The head of strategy at Barrick used to be my lawyer back at Agnico Eagle when I was CFO there. So leverage a relationship there to get into the door before our competitors were even aware that royalty package was available. And in doing so, brought in two of the biggest gold miners as a strategic shareholder in the company. Orion came in as a result of the Varus acquisition. Orion is the biggest mining private equity outfit in the world based out of New York. And they are at a 2.5% ownership as a result of the Varus acquisition we made earlier in the year and that copper stream in Europe. And as you can see, we've been able to acquire a very impressive roster of strategic and institutional shareholders since our inception back in March of 2021. When you look at our cap structure, not terribly complicated. We have 169 million shares outstanding, 199 million shares on a fully diluted basis. The biggest component of that dilution is the the warrants that we have outstanding. They're 3-year warrants that mature in May of 2027. They're struck at $225 per share. Otherwise, there's virtually no dilutive elements within our share structure. In terms of sell-side research coverage, we have 6 analysts that cover us. And as you can see, they represent some of the largest cap Canadian banks and also some significant institutional coverage within the U.S. from Raymond James and H.C. Wainwright. In terms of our firepower, we have about $5 million of cash on the balance sheet and $10 million available under our revolving credit line with BMO and National Bank Financial. Otherwise, our balance sheet is quite clean. The convertibles are non-unsecured 5-year convertibles with 7% cash coupon. So a very attractive piece of paper, and they don't mature until 2028. So with that, Jim, be happy to take any other questions that might be coming from our listeners today.
Sure. Thanks, everybody, for the presentation. And just a reminder for people on today's call, if you do have questions, please use the navigation pane at the bottom of the screen. Click on the Q&A or the chat button. We'll get those answered for you. So first question in the queue, do you have much exposure to copper? And then follow up to that is, should you, and I guess should you means either more or some.
Yeah, I'll take that one, Jim. So currently within the portfolio on an asset value basis, we're still about 90% gold, a touch under 10% copper. In the near term, we do have a larger proportion of revenue reporting in as copper, specifically as the Varus copper stream ramps up in 2025. But as assets like Cote and Odyssey really ramp up in later years, we'll balance out closer to that 90-10 proportion. With regards to how we look at commodity mix going forward, we'll always maintain vast majority in terms of precious metals, that being gold and silver, targeting 75 to 80% as a minimum. The balance of the portfolio, we will look at other base metals, liquid LME traded metals, specifically zinc, nickel, lead, and copper. We're quite bullish on copper, and often we'll gain that exposure to those commodities in polymetallic settings, that being gold, copper porphyries, or gold-bearing VMS deposits, given the robust economics that type of deposit typically delivers. So you'll always see us provide that primarily precious metals exposure, but we will look for high quality cash flowing opportunities in those commodities that we have a strong understanding in.
All right, I appreciate that, and makes sense. As part of that, what are your thoughts? And you can open this up to either you, Peter, or anybody else too. What are your thoughts on the copper price? I know it's had a little bit of a pullback here, but do you expect it to be higher, significantly higher going forward?
Yeah, look, I think the demand supply fundamentals are as robust as they've ever been. When you look at the demand side of the equation, the electrification of vehicles and the infrastructure required to support the electrification of vehicles in the Western world, we're looking for fully EV environments by 2035 by government mandate. That requires almost an exponential growth in demand. But there isn't a resultant source of supply, particularly given the significant amount of underinvestment and exploration over the last decade or so. The juniors do all the heavy lifting in grassroots exploration, and they haven't had consistent access to capital markets for at least a dozen years, and that's true in both the gold and the copper side. So as a result, we just have not seen that kind of pipeline growth that's required in terms of development stage assets to support the supply required to meet the demand. There's likely to be a continued and burgeoning increase in the deficit, supply deficit, which will drive copper prices to much higher levels. The lack of investment in exploration and development tells you that we're not nearly high enough to provide incentive pricing for the necessary exploration and development required to meet the burgeoning demand. So we're likely to see double-digit copper prices well north of $10 a pound to incentivize the necessary exploration and development required to meet societal needs for copper.
Okay, just following up on that, double-digit copper pricing, without a crystal ball, what would be your timing on something like that?
Well, given that we have some interim benchmarks in terms of meeting the electrification requirements on the vehicle side and the infrastructure necessary to do that, I say within the next 3 to 5 years is entirely reasonable in terms of achieving $8 to $10 a pound copper.
Yep. Fantastic. Appreciate that. Can you explain land agreement proceeds?
Over to Peter.
Peter, you're on mute if you're trying to talk.
Thanks, Jim. Yeah, so to cover off land agreement proceeds, this is a portion of our revenue that comes from our royalty generator model, which is an aspect of growth that's somewhat unique to us. I'll zoom out, and we have 4 main legs of growth in how we grow our business. I spoke to corporate M&A, acquiring third-party royalties, so picking up royalties from other corporates or prospectors, and also providing royalty financing as our third leg. The royalty generator model is something we inherited from Ely Gold Royalties and Golden Valley Mines and Royalties, the companies we acquired in 2021. And with those companies, we didn't just acquire a great portfolio of assets. We brought in the human capital in those businesses, specifically in Nevada, a gentleman named Jerry Bauman. What Jerry does is he goes out and he stakes claims almost somewhat predatorily around existing operations and scours the Bureau of Land Management to find opportunities where we can pick up prospective packages of land. Once we have those packages, we'll knock on our neighbor's door and offer up to sell that land package, which is of critical importance to them, and sell on that land package. But rather than looking for top monetary dollar up front, our objective is to retain a royalty on the back end of those land sales. But we will incur some cash proceeds when we sell those land packages, and that's what the land agreement proceeds is in our financial statements and is part of our revenue. We've consistently generated between $2 to $3 million a year in annual revenue through this model. So it really pays for itself, covers almost half of our G&A, and is a continuous way for us to continue to add the number of royalties we have in our portfolio at an extremely low cost. It's really just Jerry's sweat equity. There's no associated costs with acquiring those early stage royalties.
So question follow up on that then, Peter, is that unique to Gold Royalty in the sense that you're, potentially smaller and more nimble than some of the other groups out there, or is that something that, the bigger guys are doing as well?
It is something that is unique to our business. You will see some other royalty generation models at companies, and I think an important distinction of our model is we do not spend any money on exploration or investing in these assets. We simply acquire land packages and sell them on to operators, and it does take a nimble entrepreneurial team to be able to execute that model.
Yeah, I think it bears emphasizing that we don't take exploration risk. That's really not part of the model. We're a pure play royalty company. So to emphasize what Peter said, again, it's unmitigated leverage to the gold price. Because if we take on exploration risk, then we're exposing our shareholders to inflation risk that comes with those exploration expenditures. But again, our cost structure is flat, stable, and that incremental revenue growth that comes from higher gold prices and the volume growth that we expect from this prolific portfolio really falls right to the bottom line.
Excellent. Thank you. Next question. Can investors expect a dividend, and what's the potential timing if that's the case?
Look, I think we're at a point where in late 2025, where we paid down some of our revolving credit facility, we're in a position to look at returns of capital in various forms, whether that's a dividend, a share buyback. It's really what's the most accretive way to allocate that capital to shareholders. But I know that our board is very excited about returning capital to shareholders, which is really remarkable given the relative youth of this company. Again, only having IPO'd in March of 2021, to get to a point where we're actually talking about a dividend 3.5 years later, or a return of capital in some form, I think is a remarkable achievement.
Would wholeheartedly agree with that. And there's a lot of companies out there that sort of promise and never deliver. But so yeah, to see that at some point in the next, even if it's not 2025, it's soon after that, that would be fantastic. Next question. Are you a target for acquisition given your assets and where you're trading?
It's an excellent question. What I would say, and Peter, I think, emphasized this in the chart that showed the price and net asset value multiples. There are many companies that have significantly higher premium multiples to ours, and I think that's a function of scale. Some of those companies have been in the space much longer and have already realized some of their growth, or X growth, if you will. And we think there's likely to be consolidation among the smaller cap players in order to capture that type of multiple that comes from the scale and trading liquidity. What I can't predict is the sequencing, who the survivors will be. Ultimately, it's the shareholders that decide, but I think consolidation is inevitable. And in fact, since our IPO, we've rolled up 3 of our competitors when we had the currency to do that. That's been a significant pillar of our growth in the early part of our tenure back in 2021. We had a much higher share price and multiple. But I think since then, we've been much more disciplined in our focus on individual royalty acquisitions, royalty generation, project financing that we know we can do accretively. But there's been a dozen companies that have disappeared in consolidation since our IPO, 3 of which we've absorbed. And there's likely to be more consolidation going forward, given the attractiveness of scale and the premium multiple that seems to afford some of the larger cap peers in our space. So there will be consolidation. What I can't predict is who's going to be surviving, who's going to be taken over, but it'll happen for sure.
Okay. Good information. Are you currently in any indices? And is there a consensus share price target from the analysts that are covering you?
Yeah, Peter or Jackie, do you want to cover that?
Yeah, sure. So we are in the GDXJ index. So that's the index that Van Eck runs for the smaller gold mining companies. So we are in that index GDXJ. In terms of analyst coverage, like was mentioned before, we have 6 analysts covering us. They all have an outperform or a buy rating on our stock, and the average target price is about $3.25 US. So significant upside to our current share price, definitely across all of the analysts that cover us.
And for those on today's call, I do have copies of some of those reports, and I can distribute those afterwards. If there's any updates, Jackie, Peter, David, please forward to me if there are any updates on those recently. And then the next question.
I'll just say we reported our earnings on November 5th, so I can send you the research that came out after that.
Perfect. Thank you so much. Next question. Has transaction volume for gold royalties picked up in the past year, and what do you consider in selling a portfolio royalty?
Well, we don't sell our royalties. I mean, royalties run with the land, so they provide infinite optionality. We've already paid for them. So it definitely pays to be patient, given the holding costs are basically negligible or zero. So it's infinite optionality with zero cost once you own them. So selling royalties is really not in the cards for us. What I would say is the pace of acquisition has slowed considerably since 2021. We were very aggressive in 2021 in consolidating some of our peers. We pursued a roll-up strategy after a very successful IPO. We had a north of $5 share price. We IPO'd at $5, ran to $7 per share, recognized that we had a premium multiple, and we used it to our advantage in terms of growing our portfolio from 18 royalties initially to well over 190 royalties as a result of that roll-up strategy. After the Federal Reserve started tightening in early 2022, we saw a significant derating of gold equities, and in particular, our story, because we had the best growth profile in the sector, and growth was being significantly discounted in a rising interest rate environment. So we stopped doing M&A. We had to exert significant discipline, and we started to focus on, again, royalty generation, which is negligible cost for us because it's organic. We've done some limited project financing, and we've also done some third-party royalty acquisition. So we've been much more discerning in terms of our acquisitions since 2021 because we simply haven't had the currency to go out and transact in a significant fashion. So we've had to be extremely disciplined to ensure that we continue to deliver accretive growth to our shareholders. So it's been a much slower pace of acquisition since 2021.
Appreciate that, David. Just a reminder too, again, for people on the call, if you have questions or comments, please use the navigation pane at the bottom of the screen. Click on the Q&A or the chat. We'll get those answered for you. Currently, there's nothing in the queue right now. So as we potentially think to wrap it up, I have a couple of questions that I'd like to ask. Two questions that I sort of opposite of each other, but you've probably heard me ask you before. And you can pick either order and how to answer this. So one, what keeps you up at night? And two, what are you most excited about?
Well, the thing that keeps us up at night is really finding ways to creatively grow. As I said, when we had the currency back in 2021, we could be aggressive because we had the multiple advantage. Since then, we've had to be much more discerning and selective in terms of what we've acquired. And so keeping that pipeline full is a constant preoccupation for my team. And I think we've done an exceptional job of picking up some quality assets over the course of the last couple of years, even in the absence of having the strong currency we had in 2021. What gets me excited is that the fact that all this promised growth is now being crystallized as we speak. This year alone, we've seen almost a tripling in our revenue from last year. Our first 9 months actually saw positive earnings and positive operating cash flow for the first time in our history. And so we are on the cusp of delivering that pronounced revenue growth and pronounced free cash flow growth that we've been advertising since our inception back in 2021. It's exciting that we're in the midst of that. And we think the re-rate potential inherent in delivering on that is dramatic. And you can see at trading at half times price and net asset value, that's less than half of what our immediate peers in the small cap universe are trading at. So even if we got to the median of our peers, we're looking at a doubling in our share price absent any increase in the gold price. If we're able to achieve the type of multiples that the seniors in the space are achieving, we're looking at 4 to 5-fold increase in our share price absent any increase in the gold price. And we have a quality portfolio that I would stand up against any of the seniors in the space.
Yeah, so all of that says good timing for people to be on today's call. Opportunity is right there. Company's performing on all cylinders. Gold prices cooperating. Copper prices cooperating and potentially could really help out going forward as well. That appears to be the end of our questions. Unless something comes in, I will remind everybody about the company's progress and opportunities going forward as a company.
Right, if I got that right. And you made money. You had a profit. Congratulations.
We did, and we have positive operating cash flow for the first time in our history. And that's remarkable when you consider we started 3 years ago as a concept. We went public in March of 2021 with 18 royalties, none of which were cash flowing. So it was very much a concept created on the back of an envelope by my co-founder, Amir Adnani, and myself, and then grown through diversification, through the acquisition of 3 of our peers over the course of 2021. But also, we've grown through 4 distinct pillars beyond that. We've grown through, as I said, M&A, but we've done project financing. We've done third-party royalty acquisition. But also, we generate royalties organically. About a third of our royalties were created through our sweat equity at no cost to our shareholders, so no dilution, and it provides us potential for infinite rates of return on those 70 plus royalties we created through our generator model.
Okay, super. If we look at, as we said already, profit is there. That is fantastic. That leads, of course, to the question, how is Q4 running? Are you in line with your expectations or maybe better?
Well, we're poised to deliver nearly a tripling in our revenue this year from last year. And the big drivers of that are some of our most recent royalty acquisitions, including Cote, upon which we have a royalty and just started production this year and is ramping up to full scale production this quarter. So that'll be a big driver of royalty growth. We've already received 2 royalty checks in Q2 and Q3. They were relatively small as they were starting up operation. We expect a significant growth in that royalty revenue in the fourth quarter. We announced the acquisition of Varus, a copper stream on that earlier in the year by Adriatic Metals. Adriatic is now ramping that up to full production over the course of this quarter as well. And we have received our first copper streams from that so far this quarter. So that'll be a growth element as well. And Canadian Malartic continues to grow from underground production where we have significant royalty coverage. We have limited coverage on the open pit, but as they mine more and more of their production from underground, we have a 3% NSR on virtually half of the underground resource at Odyssey, which is the underground extension, Canadian Malartic. And we've also benefited from the acquisition of Cozamin this year. A full year of production from that. That's a copper silver mine in Mexico. We're operated by Capstone. This is their highest grade mine within their portfolio. And earlier last year, we announced the acquisition and project financing of Borborema, which is going to be Aura Minerals' newest mine in Brazil. We're getting pre-production royalty payments from that this year, and that mine is over half constructed, expected to be in production in the first quarter of next year. At that point, our royalty revenue really steps up as they start to deliver ounces. So we've had multiple sources of growth this year, leading to that tripling in revenue this year. And we're looking at 60% compounded annual growth in our revenue right through the end of the decade.
Wow, that's really a lot, I would say. Yeah, so all those mines and royalties you just mentioned, they really start to kick in from next year onwards, right? Because now the ramp up phase is done and then go full throttle, right?
Yeah, next year we get a full year of Cote and we get a full year of Varus, again, both of which are new operations. And also we get the benefit of Borborema starting up operation next year. Again, we've been getting limited pre-production royalty payments, but as that steps up, and I hasten to add both Varus and Borborema have massive expansion potential, which will be realized once they achieve commercial production at very low capital intensity. That being said, we own our royalties streams outright. There's no capital calls on any of them. We get that free optionality in exploration and expansion as a result of the nature of the business model that we have as a royalty and streaming company.
Okay, super. So that means for this year, the guidance was 13 to 14 million US dollars revenue. So for next year, we can then already say 20 million plus.
Well, we'll provide guidance in that regard as we get mine plans from our operators. We're dependent on that. We don't provide our own guidance. So all we do is compile the guidance of our individual operators and then provide our guidance. Basically, it's simple arithmetic. So as they provide their guidance in the first couple of months of 2025, we'll be able to compile our own guidance. But we do expect very significant growth next year in our revenue. And now we're in positive operating cash flow. Next year will be positive free cash flow next year for the first time in our history. And that will allow us to take a little bit of debt off the balance sheet. We have a small amount of debt that we used in terms of a revolving credit facility. We'd like to maintain that availability within our revolving credit facility as we look to continue to grow and acquire new royalties going forward.
Okay, super. With Varus, that rings a bell to me because I think I saw in your presentation you have approximately 90% is gold in your royalties, and I think it's 8% is copper approximately. And with Varus, you also have a copper stream there. So the question is, are you thinking in the future, let's say, to diversify a little bit out of the gold, going more into, let's say, base metals or, let's say, other metals of interest, meaning maybe a little bit more silver, because silver, I really rate also extremely high?
Yeah, absolutely. I think you will always maintain, I would say, at least 70% in gold. But diversifying into LME level metals or LME metals makes a lot of sense for us because quite often deposits are not singular in terms of their metal exposure. They're quite often polymetallic. And we like polymetallic deposits that have significant precious metal components in them because those tend to have longer lives. and they tend to have naturally low cost structures because of the byproduct credits. So they're competitive mines with longer lives and the ability to expand and grow over time with significant geological upside. So we like those polymetallic deposits, but we'll always, as our name indicates, stay focused on gold. I've spent equal amounts of my career in base and precious. I've run Hudbay Minerals. I was within net mining for many years. So I built as many copper mines as I have gold mines. So I believe in the fundamentals of copper. So having a little bit of copper exposure, a copper kicker, if you will, within our portfolio makes a lot of sense because the fundamentals are so strong. And quite often that copper is within a precious metal deposit. So we have a royalty on all of the metals, not just on singularly on the copper or the gold within that deposit.
Super, perfect. I like to hear that because I'm also very bullish for copper in the long run, as I am for silver anyhow. Silver even more in the short run, I could imagine. Do you see any, let's say, risks with larger or let's say larger royalties or coming in within the next 1 or 2 years? Do you think something might be difficult, maybe delayed, or do you see everything is really nice on the plan?
Well, the biggest sources of growth are going to come from the biggest assets we have in the portfolio, which is Canadian Malartic and the Odyssey Underground Extension. It's going to be Cote, and it's going to be Ren, which is the underground extension of Goldstrike. All those are owned by well-capitalized, large-scale operators. You know, in the case of Canadian Malartic, Agnico Eagle, the third biggest producer by market cap in the world, with and Ren, that's owned by Barrick and Newmont within the Nevada Gold Mines joint venture. And Cote, yes, IAMGOLD is a mid-tier player, but the mine is built and it actually has already achieved commercial production. So they're just optimizing it right now. And not only are they well capitalized now and that risk is behind them, they've actually exercised the option to increase their ownership in it. So they have the balance sheet capacity now, not only to optimize the asset, but increase their ownership. So they're in a great position. And that's where I would say virtually most of our growth is coming from those three assets within those well-capitalized operators. Beyond that, our growth is coming from Borborema. Aura Minerals is a diversified operator with strong track record of building and operating mines on a very economic basis within Latin America and Brazil in particular. And then Adriatic Metals, which is $1 billion plus market cap company in Australia, owns Varus, and Varus is already ramping up to production. So that capital risk is behind them, and we feel that quite confident that we're going to get not only the benefit of that ramp up, but they have significant expansion potential for very low capital intensity at that asset. And I expect they'll realize that expansion in short order once they achieve commercial production at Varus.
Okay, super. So as I saw also with your cost structure, that is really going stable, I would say. It's not rising. So that raises the question to me, because you started in the beginning to pay a dividend, then you withdrew that. Will you restart maybe with a dividend 2026?
Yeah, I think that's a realistic time horizon for us to bring that back on the table, at least talk to our board about a return of capital to shareholders in various forms. It could be dividend. If we continue to be at these depressed valuations, it could be a share buyback. I mean, those are the options that we have in front of us in terms of returning capital to shareholders. So really, the question is, where are we going to get the best bang for the buck, the best re-rate, the best allocation of that capital to get optimum return for our shareholders? And I can tell you that we'd be delighted to have that conversation. We were preserving capital for the growth that we've been able to achieve over the last year, in that we've deployed $90 million of new capital on 3 massive new mines. And that includes Varus, it includes bringing Cozamin into the table, Borborema. Those are assets that are really going to not only deliver longer term growth, but also immediate cash flow growth. Those are massively accretive on a cash flow per share basis in the short term. And so that's why we did those acquisitions. But the underlying quality of those assets mean that they're going to be around for decades and have significant expansion potential in the medium to long term.
Okay, super. So I would say from the business side, everything looks extremely well, except share price. But there you are sitting in the boat with everybody else, I would call it. As I just saw, I mean, we were talking about it. I saw the chart with the worldwide SIC and the gold price, and it's a gap like this with all the producers. And as we can also say that you are like a producer, I would call it, with your royalties. But the thing is, how do you see 2025 that this really, yeah, I would call it undervaluation or disvaluation in the sector might maybe dissolve? And what is your view, let's say, on the precious metal markets?
Why don't I start with precious metals? Because I think that provides maybe a contextual framework for
That's
the
easier.
other question. But look, I think that regardless of who had won the U.S. election, I think the refrain would have been the same. It would have been expanding monetary supply and also expanding fiscal stimulus. I think that's inevitable regardless of who had won the election, whether it would have been Donald Trump or Kamala Harris. So I think they have no choice, given the exorbitant amount of debt that's been strapped on at the government level in the US. They can do nothing but inflate that debt away. They're going to have to continue to expand money supply and introduce stimulus into the market in order to make that debt a smaller component of GDP. So they're going to have to continue to stimulate. And we've seen interest rates pivot to much lower levels, and that refrain will continue in the foreseeable future. And I think that means that gold will do extremely well in an expansionary monetary environment that we find ourselves in. And it's not like that's new. That's been in place for 50 years. I mean, you can go back to the early 1970s when the fiat currencies were decoupled from the gold standard. It's been a one-way trade. You know, we've seen the gold price go from $35 an ounce to almost $2,800 an ounce. Well, what's happened to the purchasing power of the U.S. dollar? It's gone down 96% over that period of time, and that's not a phenomenon that's recent. It's going to continue for the foreseeable future, particularly given that global debt to GDP is at 350%. So, what does that mean for the gold sector? Well, we all love a higher gold price. That means increased profitability for most of us. I think it's a struggle for most producers, particularly among the larger cap players, because they're not immune from cost inflation that's happening in the general economy. And we've seen that. The correlation between the gold price and all-in sustaining costs over the short, medium, and long term is plus 90 R squared. Like it's uncanny. And so all-in sustaining costs will necessarily go up as the gold price goes up, because gold price is a barometer of real underlying inflation. And so it's difficult to be a producer in that environment, and also in the environment where you have shrinking reserves, because the juniors have not had access to capital for a dozen years. Reserves are declining, and all of the producers have been basically playing Pac-Man. They're cannibalizing each other. That does not add value. That increases shares. If shares are staying, but does not increase reserves and resources. That's why I think the best place to be positioned to get optimum leverage to the gold price and leverage to exploration is in the royalty and producer universe. You've heard me say, Johan, it's not an accident after 35 years of building operating mines, I'm running a royalty company. I believe in the fundamentals of gold. What I don't believe is in the ability of the producers, particularly among larger cap players, to grow, and certainly not grow per share value. And that's why your best position as an investor to get that top line exposure and protection from inflation within a royalty vehicle, and also get the leverage to the exploration upside of the operators that we own royalty on their properties. Our operating partners invest over $200 million a year in exploration, over 500,000 meters of exploration drilling. You know what we contribute to that budget every year, Johan? Zero. We get all of that upside without having to pay for it. That's a really good position to be in. And they need to conduct their exploration in order to preserve their reserve profiles within their existing operations and feed their massive industrial complexes. So we're going to get the benefit of their exploration efforts without having to pay for it.
Absolutely. And they have to replace also what they have produced. Absolutely. That's also very important. So what's then your gold price prognosis for next year?
$3,000 is basically a slam dunk. The question is, how far beyond that will it go? And I really think it depends on how much stimulus the U.S. introduces, and by necessity, the other Western nations do in order to maintain competitive advantage with the U.S. So the U.S. is going to rule, and the U.S. will be necessarily stimulative because of the reasons I mentioned. They need to inflate debt away. They're going to introduce stimulus in a fiscal standpoint, but also from a monetary standpoint. I think that's going to continue unabated for the foreseeable future in order to sweat that debt away, inflate it away.
Yeah, absolutely. You have also a view on silver, because I think that's also a very interesting situation. how I see it.
Yeah, I agree, Johan, and I won't talk about silver fundamentals. So I think silver fundamentals are stronger than even gold because there's actually industrial utilization of silver in a very major way. But let's set that aside for a minute. Let's talk about silver as a proxy for gold. And historically, in bull runs for the gold market, you've seen gold to silver price ratios narrow to 40 to 1. It's close to 100 to 1 now. It makes no sense. In a bull run for gold, the silver should vastly outperform gold in a bull run for gold because that ratio will necessarily narrow. It has the potential to outpace gold performance twofold in order to get to more historic norms in the type of bull cycle that we're experiencing now for precious metals.
Absolutely. I see it the same way, definitely. So far, I think Q4, we did not really talk about it, but it looks all good.
Yeah, look, we're forecasting to achieve our production guidance or revenue guidance, excuse me, of $13 to $14 million, which puts us in a position to actually deliver record revenues. We've already had record revenues for the first 9 months of this year, and we'll be in record territory for the full year as well.
Perfect. I love that. Record territory. That's a great final word. David, thank you very much. I think you guys did everything really right. And I'm a happy shareholder despite the share price. But I think it's now, I mean, you are a really great quality company with a fantastic growth path as you have described. And that's exactly where I want to be invested in. And I'm pretty sure that this undervaluation will be corrected soon here. Definitely.
Yeah, absolutely. And I should add, just to put an exclamation point on this, there has been insider buying in the stock in the recent days that we filed. And I continue to be a buyer in this market just because this valuation is ridiculous. And I can't think of a better place to allocate my personal capital than back in my business that's so severely undervalued.
Definitely, I see the same way, especially when you restart with the 1 cent dividend per quarter. Then it's getting also interesting because by today that would mean already over 3% dividend yield. I like that. Super. David, I wish you very, very well. A Merry Christmas. All the best
Merry
for
Christmas to you.
2025. And I would say keep it going with the team. And we talk in, January, February when you have your numbers out.
All right. Looking forward to
Super.
it.
Thank you very much. Thank you.
Ran Hudbay Minerals in the copper business for 6 years and was the CFO of Agnico Eagle for a dozen years. So I've been involved in the construction of 15 mines over my career, run countless more operations within the portfolios of each of those companies. And what I would say about gold fundamentals, which I think provides valuable context for Gold Royalty and our business model, is that gold has never been in a better position to provide all-time highs against all the major currencies globally. And the fundamentals that are driving gold are the same types of fundamentals we saw back in the 1970s when we last had a major inflationary cycle. We saw a massive expansion of money supply. And in fact, if you look at gold over the last 50 years, it's really been a one-way trade. It's gone from $35 an ounce when the US government abandoned the gold standard in the early 1970s to over $2,800 an ounce today. And over that time, the purchasing power of all the major currencies globally in the Western world have gone down about 96, 97%. When fiat currencies become untethered from any physical backing, fiat currencies can only do one thing. They can only depreciate in value because the temptation for governments to expand money supply is immense, particularly in this environment today where we find debt levels at all-time highs. Back in the 1970s, when we had a big inflation cycle, global debt to GDP was only 100%. So as you can imagine, when Paul Volcker came in to run the Federal Reserve, he had the latitude to raise interest rates dramatically to tame inflation. And we experienced a peace dividend over 20 years of virtually zero inflation as a result of his efforts. He brought interest rates to 20%. Headline inflation back then was around 14, 15%. And he brought inflation down to 0 to 2% for a 20-year period. Today, global debt to GDP has reached 350%. So as you can imagine, central banks globally have very limited latitude to raise interest rates in order to tame inflation because it would bankrupt governments. In the US, for example, debt service has doubled over the last 18 months to $1 trillion per year. And as treasuries are refinanced over the course of the next 18 months, no matter what happens to nominal interest rates, Debt service in the US will double again to $2 trillion. To provide you some perspective, that's 2 out of every $7 of tax revenue generated in the US. That's simply unsustainable. So the only way for central banks and for governments globally to deal with this pile of debt is to inflate it away. And I think we all appreciate that inflation that's reported globally, the headline numbers, vastly understate the reality on the ground. Nobody here is experiencing single-digit inflation. If you're putting food in your stomach, fuel in your car, or you're putting a roof over your head, you're experiencing double-digit inflation. What that means is that real interest rates are in negative territory. That's what's driving this flow of capital into gold. And that's why we've seen gold prices achieve all-time highs on a nominal basis. We still have not achieved all-time highs for gold on a real basis. If you look at the peak gold price back in the early 1980s and inflation adjusted to 2024 dollars, that would be well over $2,800 an ounce. But back then, again, debt levels were much more manageable and sustainable, and they are today. So that means that gold is likely to go much higher because it is an accurate barometer of real inflation. And real inflation is much, much higher than the central banks would like you to believe. And so we're going to see a continued devaluation of fiat currencies in order to devalue the debt that these governments are currently trying to service and are unable to service in a fiscally responsible manner. So if you buy into gold as an asset class, the question you have to ask yourself as an investor is, where are you best placed to get optimum leverage to that gold price? And it's not in the producer universe, unfortunately. I've spent my entire career building and operating mines, and I can tell you the reason I'm running a royalty company today is because the industry is shrinking. Global reserves in the ground have gone down 40% over the last 12 years. In other words, the mining industry continues to shrink because they have not reinvested money into exploration to replace depleting reserves. The juniors in our sector, as you well know, have not had access to capital for a dozen years, and they are the ones that do all of the heavy lifting on exploration. They're the ones that make the major discoveries, and because they have not accessed the equity markets for a dozen years, there have been no significant discoveries in our industry. So not only do we look at gold as a currency, and the fundamentals are absolutely profoundly strong for it, but when you look at the supply dynamic in our industry, it's continuing to shrink, and so there's a supply squeeze from a miner's perspective. And also, the producers are not only facing declining reserves, but they're also facing significant inflation in their input costs, capital and operating costs. So their margins are not expanding. That's why we're not seeing the gold equities on the producer side perform as we expect them to perform. Gold's up 30% this year. The bigger producers in the world are only up 30%. In other words, they performed exactly in line with the commodity, but they should be offering you leverage to the commodity price. They should be vastly outperforming the commodity, but they're not doing that because their reserves are shrinking and their operating costs are going up. So the place to get optimum leverage to the gold price is in the royalty universe, where you get a percentage of the gross revenue, and you're completely protected from inflation at the mine site. In addition, you get the leverage to the exploration upside of the operators of the mines that we have royalties on. So as they conduct exploration, we don't contribute to their exploration budgets, but we get the benefit of that upside because our royalties run with the mine. And so, again, optimum leverage to the gold price with complete protection from inflation and leverage to exploration. That's where you're going to get outsized returns relative to the commodity. And that's why I've co-founded a royalty company after 35 years of building and operating mines. I believe in gold as an asset class, but I'm not comfortable that the producers in our universe can offer you leverage to the commodity price, but a royalty company can. And over the last 3.5 years since we founded the company, we've grown from 18 royalties to over 240 royalties. And this year, after starting up the business 3.5 years ago, we're actually in the free cash flow territory. We're in an inflection point as many of our operating mines come into production and our revenue expands exponentially over the course of the next 5 years and our free cash flow grows dramatically. So we're not only in a business that's optimally leveraged to the gold price, but we're in a business, regardless of what happens to the gold price, we'll see significant volume growth in terms of the attributable ounces we're getting from the mines that we have royalties on. And we're getting the full benefit of the upside in the gold price that we're likely to receive as an industry over the course of the next several years as fiat currencies continue to be depreciated and gold price continues to go up. And the reason we've been able to grow the business so quickly and so dramatically is because many of the people within my executive suite and on my board have similar experience levels to me. We only have 8 full-time equivalent employees. We have 6 directors, but collectively over 400 years of industry experience. So many of us have come from an operating and mine development background, and that gives us 2 distinct advantages. One, it gives us a clear-eyed view of the underlying risk of what we're investing in. So when we put capital to work with a mine and take a royalty back in return, because we were developers and operators ourselves, we understand the intrinsic risk and we can price it appropriately to make sure that our shareholders get maximum rate of return. The other thing that it offers us with 400 years of collective industry experience is access to anybody in the mining industry that we want to do business with. It means that we get access to royalty opportunities before many of our competitors are even aware of them. That's why we've grown the business so quickly. We've increased the number of our royalties 15-fold in 3.5 years, and we're going to see 60% compounded annual growth in our revenue over the next 5 years as we deliver this production growth that we've already bought and paid for. And the other attractive feature of our model is every single one of our 240 plus royalties are bought and paid for. We have no capital calls. All we have to do is sit back and harvest the returns on the mines that our operating partners are building, exploring, and expanding and optimizing. So this gives you an overview of how we've grown that portfolio. We started with 18 royalties in our IPO in early 2021, and through a series of acquisitions of other royalty companies, we added over 150 royalties over the course of 2021 as we took over 3 companies. And then we've grown through other means such as project financing, where we provide capital to the operators to expand and explore and develop their mines. We acquired third-party royalties from prospectors who were looking to monetize the royalties on the properties they staked. And we also grow through our organic royalty generator model. In other words, we stake exploration claims around existing mines, and then when the neighbor knocks on the door and says, I need that piece of property because our deposit trends into it, we sell them the property and take a royalty back in return. And about 1/3 of the royalties that we own, we generated that way through our sweat equity. So even if one of them generates a significant royalty, our rate of return is infinite because our cost of entry is effectively 0 on those organic royalties that we've generated internally. So we have a high rate of return business because we've grown through 4 distinct pillars, which is a unique feature of our royalty company relative to our peers. Many of the royalty companies grow through 1 or 2 or maybe even 3 of those pillars, but we grow through all 4. And again, even among the larger cap players in our space, we're unique in that regard. So these are the 4 pillars I was talking about. Again, M&A, when we have the currency in order to transact, we rolled up some of our competitors. We've done project financings. We've done third-party royalty acquisition. And I think importantly, we generated 2 to 3 royalties per quarter through our organic royalty generator model, again, through our staking and farming out process that generates royalties effectively for free. And this just gives you an overview of our revenue growth in the current year. We're looking at nearly a tripling in our revenue as a number of our late-stage development projects come into production, namely Côté in Canada, IAMGOLD's newest mine, Varus, where we acquired a copper stream in Bosnia. Adriatic Metals has brought that mine into production this year. And also Canadian Malartic, the largest producing gold mine in Canada, is generating increasing revenues and cash flow from its underground operation as it completes a $1.6 billion expansion by my old company, Agnico Eagle, that's the operator of that mine. Over the long run, again, over a 5-year period, and these are consensus estimates, we have 6 analysts that cover us, we're seeing a 60% compounded annual growth in the attributable ounces, and that's the bar in this chart, the yellow bar, over the course of the next 5 years. When you apply the gold price to that, and then you can pick the gold price you want, these lines represent our revenue at various gold prices. At current gold prices, we're going to see our revenue approach $80 million by the end of the decade, up from $5 million last year. So again, exponential growth, and this is against a cost structure of only $7 million per year. We have 8 full-time equivalent employees, and I can assure you we could run a business with 2,400 royalties with the same number of employees. It's the scalability of this business that makes it so attractive. Every incremental dollar of revenue goes right to the bottom line and generates an incremental dollar of free cash flow. It puts us in an excellent position to start to return capital to shareholders by the end of next year. So it's a remarkable process that we've undergone. We started up with no revenue and only 18 royalties in 2021. Today we have over 240 royalties. We have exponential growth in our revenue. We have free cash flow generation. As you can see, our generation and free cash flow increases dramatically over the course of the next 5 years as many of these large-scale mines come into full-scale production by the end of the decade. And this is a value play right now. We're trading on a consensus basis at less than half of NAV. Why are we trading so discounted given the quality of our portfolio? Is because we have the most significant growth, and growth has been severely discounted in our industry. But the re-rate potential is significant as we crystallize that growth. And that growth is not a far-off proposition anymore. We're right in the midst of it. This year, we're seeing our revenue effectively triple. And again, we're seeing 60% compounded annual growth each and every year right through the end of the decade. And we are right in the middle of it, which means that re-rate opportunity is significant near term. Even if we get to the median of our small cap peers, we would see at least a doubling in our share price. If we got up to the kind of multiple that the senior royalty companies have already achieved, then we could see a 4- or 5-fold increase in our share price, absent any increase in the gold price. Again, it's just based on volume growth from the many large-scale royalties that we have within our portfolio. And this gives you an overview of our pipeline. We have 7 cash-flowing royalties. We have another 14 in various stages of construction and development that underpins that significant revenue growth. And then we have significant optionality within the advanced exploration and exploration stage royalties that provide us upside from an exploration perspective. Again, all of these royalties are completely bought and paid for. We never have to put another dime into them. All of our operating partners are conducting the development, the exploration, the expansions on their capital budgets. So we never have to put another dollar in them to realize that significant growth that we talked about a little earlier in the presentation. And as you can see, we have over 80 operating partners within our portfolio, and all the biggest gold producers in the world are our operating partners, which means that our operating partners that own the underlying mines that we have royalties on have both the balance sheet capacity and the technical strength to grow and optimize their operations. So some significant catalysts this year that are driving the revenue growth. As I said, we're looking at nearly a tripling in our revenue this year, driven by some of the biggest operating mines in North America and beyond. And this year in particular, Côté, which will represent Canada's second biggest producing gold mine, came into production. As it ramps up, our revenue is ramping up from that. We have a new copper stream from Varus, Adriatic Metals' newest mine in Bosnia. We also have increasing revenue and cash flow from Canadian Malartic, which has been Canada's biggest producing gold mine for over a dozen years. So a very solid portfolio of operating mines with a heavy concentration in the Americas. In fact, we have royalties on 3 of the 5 biggest producing gold mines in North America. On Canadian Malartic, Agnico Eagle's mine in Quebec. On Côté, IAMGOLD's mine in Ontario. And also on the underground extension of Goldstrike, which is the biggest producing gold mine in North America, owned by Barrick and Newmont in Nevada. So not only do we have a diversified portfolio, but we have one concentrated on some of the biggest, largest scale, longest life deposits to provide us a foundational element to our story. So I can see that we're running out of time. With that, I'd like to welcome any questions that you might have.